Okay, let's unpack this because it is one of those things that on the surface just doesn't make any sense.
Right.
We are living through the absolute golden age of artificial intelligence.
Yeah.
It's everywhere. And if you had to pick one company, just one, that is synonymous with this revolution, who is it?
It's Microsoft, hands down, no question.
Exactly.
Mm-hmm.
They backed OpenAI before it was cool. They own the corporate software world. They have pockets deeper than the Mariana Trench.
Uh-huh.
But here's the paradox, and this is what's driving me crazy. You look at the scoreboard for 2025, and while NVIDIA and Google are out there popping champagne and beating the S&P 500, Microsoft is just kind of sliding or stagnant.
It feels wrong, doesn't it? Like the math isn't mathing.
It feels completely wrong. So that is our mission for this deep dive. We are going to look at the anatomy of this corporate crossroad.
Yeah.
We need to figure out why the market has suddenly decided to get, well, exquisite or picky about Microsoft. We need to talk about whether this AI bubble is about to pop. And honestly, we're going to look at a future where the customer for Microsoft might not even be a human being.
Which is a mind-bending concept we will absolutely get to. It's a big one.
And to help us navigate this, we're leaning heavily on the insights of Mooky Tenenbaum. He's a financial analyst who specializes in dissecting the intersection of AI and market movements. And he has a really unique take on why Microsoft is stumbling while its peers are sprinting.
And Tenenbaum really doesn't pull any punches here. He suggests that what we are seeing isn't just a bad quarter. He thinks it's a full-blown identity crisis.
An identity crisis for a $3 trillion company. Is that even possible?
Oh, it's more common than you'd think, especially during a massive technological shift like this one.
All right, well, let's jump right into the crime scene, the stock chart. What is actually happening here?
So, context is key. Microsoft has been trending downward or, severely underperforming compared to what we call the Magnificent Seven.
Right.
Specifically, if you look at the end of 2025, Tenenbaum points out a really stark statistic. Only 2 companies in that group actually beat the S&P 500 index.
Oh, what do you guess? NVIDIA.
NVIDIA and Google. That's it.
Wow.
Everyone else, including Microsoft, despite being the so-called first mover with OpenAI, did worse than the general market.
That's incredible.
And Tenenbaum identifies 2 immediate, very human reasons for this.
Okay, hit me.
The first is it's simple profit-taking. You have to remember, when ChatGPT first launched, Microsoft's stock went vertical. I mean, it shot up.
Oh, yeah, I remember.
They own 49% of OpenAI, so investors rode that wave all the way up, and now, logically, they are cashing out those gains.
So it's not panic selling, it's just thanks for the money selling.
Precisely. It's a natural cycle. But the second reason is more structural. This is where it gets interesting. Tenenbaum describes the market as becoming exquisite, demanding. The hype phase is over. The honeymoon, where you could just say the word AI and your stock would jump 10%. That's done.
The magic word doesn't work anymore.
Anymore. Now, investors are looking at the price-to-earnings multiples, which are getting a lot tighter, and they're demanding to see the receipts. They want to know, okay, you spent billions on data centers. Where is the cash flow?
It's the show me the money phase of the tech cycle.
It is, and Tenenbaum notes that Microsoft is currently trading about 20% off its maximum highs.
20%.
Now, for a volatile startup, that's a Tuesday. For a company as stable and massive as Microsoft, that is significant correction, a really big deal.
That is huge. And you mentioned this idea of an identity crisis. I feel like Microsoft has been the sturdy, reliable grandfather of tech for so long. How do they have an identity crisis?
Well, this is a core part of Tenenbaum's argument. He says Microsoft hasn't quite decided what it wants to be when it grows up in this AI era. Are they a provider of infrastructure, like Amazon with AWS? Or are they an application layer, a user of the tech to boost Office?
They're trying to be both, aren't they?
They're trying, but there's a specific deficit that Tenenbaum highlights, which really separates them from the pack. The chip deficit.
The chip deficit, what's that?
Think about the other giants. Google, Amazon, Meta, what are they all doing?
I know Google makes their own TPUs, their tensor processing units.
Exactly. They are all getting into manufacturing their own silicon. They're trying to compete with, or at the very least, rely less on NVIDIA. Microsoft isn't.
Oh.
They are still almost entirely reliant on buying chips rather than making them. So in that specific vertical, that part of the supply chain, they are basically absent.
So they are exposed to the costs and the supply chain issues that the others might be able to control better.
Exactly. They have less control over their own destiny in that regard. And then there's the OpenAI situation.
Which I always thought was their ace in the hole. I mean, owning almost half of the most important AI company on Earth seems like a pretty good strategy to me.
It was a brilliant strategy to start, a real coup. But Tenenbaum points out that this massive 49% investment has actually complicated their life significantly.
Complicated how?
He calls it an endogamic relationship.
Endogamic.
Yeah, incestuous almost. Think about it. Microsoft uses ChatGPT technology to power Copilot, right? That's their flagship AI product.
Right, it's in everything now.
But at the same time, they are desperately trying to make Copilot independent. They don't want to just be known as a wrapper for OpenAI. They want Copilot to be its own entity, its own brand.
It's like trying to launch a solo career while you're still the lead singer of the band.
That is a perfect analogy.
Yeah.
And you can see them hedging their bets now, which is very telling.
Well, so?
Tenenbaum highlights that Microsoft is now investing heavily in Anthropic, the makers of Claude.
Right, OpenAI's biggest competitor.
Exactly. And other non-public AI companies, too. They are spreading their cash around because they realize that tying their entire destiny to OpenAI might have been a bit too restrictive, maybe even a mistake.
It's funny you mentioned Copilot. I have to share this because it drives me nuts. I use Word and Excel every single day, obviously. And I feel like I am being aggressively nudged, almost forced, into using these new AI features.
Oh, I know the feeling.
It's like the ghost of Clippy has returned, but now he has a PhD in linguistics and costs $20 a month.
It's the captive audience strategy, and Tenenbaum makes a really, really sharp observation about this.
What's that?
He says, look, if this strategy of forcing AI onto their massive user base was actually working perfectly, if people were happily paying for it and productivity was exploding across the board, the stock would be soaring.
But it's not.
No. The fact that the stock is down suggests that this forced adoption hasn't translated into the revenue spike investors were promised, at least not yet.
So the adoption isn't happening as fast as they hoped.
Or the monetization isn't. Tenenbaum actually has a funny suggestion. He says you should ask Copilot itself what it thinks of the stock.
Wait, really? What would it say?
He notes that while these AIs can be a bit sycophantic, they tend to suck up to the user, they are programmed to be truthful about public data. But the user experience is key here.
Right.
Copilot, in Tenenbaum's current view, is essentially just chattier GPT. It's highly integrated, which is its strength. It encourages you to stay inside the Office ecosystem, which is great for retention, but is it revolutionary enough to justify the billions and billions in spending? The market isn't convinced yet.
And speaking of convincing the market, we have to talk about Satya Nadella. He was just at the World Economic Forum in Davos, and he dropped some pretty heavy warnings.
He did. It got a lot of headlines.
It basically said that if companies don't adopt AI quickly, the whole bubble is going to burst. It sounded like a dire warning from a visionary CEO.
Oh, was it?
Oh, I sense a butt coming on.
Tenenbaum is incredibly cynical about the speech, and I think he's right to be. He analyzes this not as a warning, but as a sales pitch.
A sales pitch?
Absolutely. When a CEO tells you, the economy will crash if you don't buy my product, that is a fear tactic. Pure and simple.
Nice economy you have there. Shame if something happened to it.
Exactly that. Tenenbaum emphasizes a really good rule of thumb. You should only really trust a CEO's public statement if it goes against their own interests.
Okay, that makes sense.
If an oil CEO says, we need to stop drilling immediately, you listen. But Nadella saying, you need to buy AI licenses faster or the bubble bursts, well, that aligns perfectly with his immediate need to sell more licenses.
So he's just trying to create urgency.
He is trying to, because the reality on the ground, and Tenenbaum references various studies and consultancies on this, is that corporate AI adoption is much, much slower than predicted.
And why is that? Is the tech just not good enough yet?
It's not about the utility of the tech. The tech is amazing. It's about inertia.
Corporate inertia.
Yes. Tenenbaum suggests the real bubble risk isn't that AI is useless, but that there is a massive disconnect between the speed of investment billions spent on data centers and the slow speed at which big corporations actually change their fundamental workflows.
Right.
You can't just flip a switch and have a Fortune 500 company run on AI overnight. It takes years of integration, training, and changing habits.
So they built this giant, beautiful stadium but all the fans are still stuck in traffic trying to get there.
That's a great way to put it. And that leads directly to the market's fear of the CapEx black hole.
CapEx, capital expenditure, the spending.
Right, the spending. Microsoft is spending a fortune building this infrastructure, and Tenenbaum draws a really interesting comparison to Oracle here.
Oracle, how do they fit in?
Well, Oracle took on massive debt to build their data centers. It was a huge, risky bet.
I remember that.
Now, Microsoft is using its own cash. They have zero debt issues. They're swimming in money. But the market sees Oracle struggling with its bet, and it punishes Microsoft by association. They see all this money going out the door for data centers, and they panic, thinking, what if it never comes back?
That seems really unfair if Microsoft is just spending cash on hand and not taking on debt.
Markets aren't always fair. They move on sentiment and fear. And right now, the sentiment is fear of overspending on AI infrastructure without seeing the immediate return.
Okay, so we have the stock drop, the identity crisis, and this sort of cynical sales pitch. But there are outside forces here, too. And this part of the deep dive really surprised me. I did not expect Donald Trump to make an appearance in a discussion about Microsoft's stock valuation.
It's the geopolitical layer, and it's absolutely crucial to understanding the full picture.
So Trump claimed Microsoft is driving up inflation. How?
Specifically electricity prices. He criticized them for the massive energy consumption required for all this AI processing, arguing it's raising utility costs for regular people.
Is that even true?
Whether that is economically sound is very debatable, but that doesn't matter. Microsoft had to immediately respond. They came out and said, we will pay for our own energy.
They went into full damage control mode.
They had to. Tenenbaum notes that even if the accusation isn't fully accurate, the political spotlight itself contributes to the stock's volatility. It adds a regulatory risk flag that investors really, really don't like.
But there's a bigger geopolitical issue than just U.S. electricity prices, right?
Hmm.
Tenenbaum talks about a void.
The China void. This is one of the most significant structural insights in Tenenbaum's entire analysis.
Okay.
When investors and analysts first priced in the growth of AI, they did that classic back-of-the-napkin math. They looked at the global population, the global economy, and they calculated the total addressable market, or TAM.
And they included China in that math, obviously. 1 billion plus people.
They absolutely did. But the reality, as Tenenbaum points out, is that you cannot sell advanced AI chips or certain high-end AI services to China. Not because of a lack of demand, but because of sanctions and trade wars.
So you are taking the world's second largest economy completely off the board.
Completely removing it from the equation. Tenenbaum puts it very bluntly. Investors who believe the propaganda that China is a viable market for cutting-edge U.S. tech are consistently wrong.
Wow.
So when you remove that massive chunk of the world from your revenue projections, suddenly those quarterly earnings reports start to look a little disappointing. That missing market is a huge part of why the stock is lagging.
But does that mean Microsoft is vulnerable? You know, if they lose China, are they a weaker company?
Paradoxically, no. And this is another key insight from Tenenbaum. He asserts that being a U.S. company is the ultimate geopolitical moat.
A moat, like a defensive ditch around a castle.
Exactly, a barrier to entry. Look at Europe. They have Mistral, which by all accounts is a great AI model. But Tenenbaum argues it has a very low ceiling simply because it isn't American.
Just because of its nationality.
Yes. The technology, the capital, the political power, and the sheer scale of the market are all centered in the U.S. Being an American tech giant is a massive, massive advantage, even if you can't sell in China.
It's like the Roman Empire of tech.
Yeah.
At the end of the day, you want to be headquartered in Rome.
Precisely. That's where the power is.
Okay, I want to pivot to what I think is the most mind-blowing part of Tenenbaum's analysis. We've talked about adoption being slow. We talked about humans not buying enough licenses yet. But then he just flips the entire script.
The agent economy, this is the big one.
This was the aha moment for me. I was asking about, demographics and declining birth rates. Fewer people born means fewer workers in 20 years, which means fewer licenses of Word and Excel sold.
Which is a very logical, linear way of thinking.
Right. But Tenenbaum says the customer of the future isn't a human at all.
This is the key insight that changes how you have to view Microsoft's entire strategy. We are moving from software for humans to software for AI agents.
Okay, break that down for me. How does that actually change the business model?
Okay, think about a standard company today. You have, say, 150 employees. So you buy 150 licenses for Office 365. That's the current revenue model. Pretty simple.
Okay, makes sense.
In the future, Tenenbaum envisions a scenario where you might have one sophisticated AI agent doing the work that those 150 people used to do.
So, you only sell one license. That sounds like a complete disaster for Microsoft's revenue.
It sounds like a loss if you are still thinking about selling seats or licenses. But this is the pivot. According to Tenenbaum, the revenue comes from compute and energy.
Compute and energy.
Yes. Microsoft stops selling access to software and starts selling AI working hours.
Oh, wow.
Think about a consulting firm like Accenture. They don't sell you a product. They sell you billable hours of their human consultants. Microsoft will sell you billable hours of their digital agents. And those agents consume vast, vast amounts of paid compute power running on Microsoft's servers.
So when I see them building these massive data centers that cost billions and billions of dollars, they aren't building them for me to type a Word document a little bit faster.
No, absolutely not. Tenenbaum is very clear on this. They are building the housing for a new digital workforce. They are building the infrastructure, the digital factories that these agents will live in and work in 2047.
That completely reframes the CapEx. It makes perfect sense now. They are building the factory for the workers of the future, and the workers just happen to be software.
Exactly. It explains why they seem to be ignoring the short-term stock drop.
Right.
They are playing a completely different, much longer game.
So this is why Tenenbaum isn't bearish on the stock.
Not at all. He believes the stock is lagging, not dying. It's just in a pause, a messy transition period before this agent economy really kicks in and proves the immense value of all that infrastructure they're building right now.
It's a brave new world. But let's bring it back to the present for a second. Can Microsoft actually afford to wait for this future? We compared them to Oracle, but what about a company like IBM?
Tenenbaum loves the IBM comparison. He compares modern Microsoft to the IBM of 30 years ago.
Is that a compliment? I mean, IBM is kind of boring.
It is boring, but it's incredibly profitable and stable. What do they sell? They sell reliability.
Right.
They aren't the cool, innovative risk takers anymore. That's Google, testing all their wild moonshots. Microsoft is the safe bet for the Fortune 500. Their quarterly reports are obsessed with numbers and results, not big visionary projects.
So boring is good if you're managing a pension fund, I guess.
And boring means cash, a lot of it. We asked earlier if Microsoft can fix its identity crisis. Tenenbaum is adamant. Yes, they can, because they have the purchasing power to do whatever they want.
They can just buy their way out of any problem.
It's the classic Microsoft playbook. It's what they've always done. They bought DOS, they bought PowerPoint, they bought Hotmail. They didn't invent them.
Right, they acquire.
And Tenenbaum points out that if they really felt threatened, they have the war chest to go out and buy a company like Anthropic tomorrow.
Even with that massive valuation everyone's talking about.
In the context of the figures discussed, Tenenbaum mentions a figure of $350 billion in value regarding Anthropic. Microsoft has the leverage and the capacity to make massive landscape-changing moves. They can afford to buy innovation rather than build it from scratch.
That's a luxury most companies on Earth do not have.
And that's why Tenenbaum concludes that Microsoft isn't really in trouble. It's just in a waiting room for the next phase of the economy to begin.
So let's try to summarize this deep dive, because we covered a lot of ground here.
We did. It's a complex picture.
We have a stock that is down because the market basically got ahead of itself. Investors expected immediate cash flow from AI, but the reality of corporate adoption is slower.
Right. A classic case of profit-taking meeting sky-high expectations.
Then we have this identity crisis where Microsoft is caught between being a chipless software vendor and an AI infrastructure giant, all while managing a very messy and endogamic relationship with OpenAI.
And trying to hedge their bets by diversifying with investments in Claude and other AI players.
And finally, we have the long game, this radical transition from selling licenses to humans to selling compute power to AI agents.
Which is the chaotic and probably confusing bridge they have to cross right now.
So, Tenenbaum's final verdict on the stock.
He believes the stock is lagging, not dying. The fundamentals are rock solid. The cash is there. The China void is already priced in by savvy investors. He sees it as a buying opportunity if you believe in that agent-driven future.
It's fascinating. You know, this whole discussion about the agent economy left me with one final kind of provocative thought.
What's that?
If Tenenbaum is right, and the future customer is an AI agent, not a human, does the user interface become obsolete?
Obsolete? What do you mean by that?
Well, all business software today is designed for human eyes and hands. You know, buttons, menus, ribbons, mouse clicks, screens.
Like the whole GUI.
But if an AI is doing the work, it doesn't need a screen. It doesn't need a button to click. It interacts directly with the code with APIs. Are we investing billions in software designed for eyeballs when we should be investing in software designed for nothing? Just pure, invisible code-to-code interaction.
That is the trillion-dollar question, isn't it? If the user isn't human, the interface is just friction. It's an unnecessary overhead.
Exactly. Maybe the future of Excel is just silence and then the results appear. No spreadsheet necessary.
I think we should ask Copilot what it thinks about that. It might have an existential crisis.
I'll ask it right after I ask it why my stock portfolio is down. I'm sure it will have a very polite, sycophantic answer.
Good luck with that. I'm sure it'll be very helpful.
Thanks for listening to this deep dive. We'll catch you on the next one.